Well, in just a few hours, the latest look at the health of the U.S. economy. The monthly personal consumption expenditures index is a key measure of inflation, tracking a wide range of goods and services. It's also the Fed's preferred inflation gauge. It'll also give us some data on how much the U.S. spent on those goods and services in February. Now, last month's report showed that consumers pulled back their spending in January by the most in nearly 4 years. We do typically see shoppers ease off at the start of the year after the expensive holidays in December. But economists are seeing that and warning that that could be a potential red flag despite inflation cooling a bit. Let's now bring in Bill Lee, chief economist at the Milken Institute and also the former managing director at Citigroup. He joins us now from Henderson, Nevada, where it is 2:47 a.m. Bill, great to have you. I'm not sure if you stayed late or you woke up early, but nonetheless, we appreciate you being here. So let's start with the inflation report in a few hours. What are you watching for? What are you looking for?
Well, so far, the trend in inflation really hasn't gone the way the Fed had wanted. It wants to see a steady decline down to 2%. Instead, inflation has really started to stay and hang around that 2.5% area, and it's been stubbornly sticky. So the Federal Reserve right now is on hold because it feels the economy is doing quite well otherwise in terms of labor market, but the inflation numbers just aren't cooperating enough for them to continue their rate cuts.
Do you expect a similar trend in this morning's report?
Yeah, I think it's going to stay that way for a while. It seems as though there are downward forces for pushing the prices down have pretty much eased. In place of it is a lot of uncertainty, and people don't want to change anything right now, not pricing, not employment, not any kind of business decision until they get a clearer sense of where the economy is going. And by the way, that's something else the data are going to tell us this morning, because the thing that's holding up the U.S. economy has been very strong consumption. Consumers have been outpacing their income growth in terms of spending. And one of the signs of weaknesses in the economy is the fact that 80% of the consumption growth we've seen over the last several quarters has been due to about 20% of the population who have the money to spend. 60% of the population really hand them out from paycheck to paycheck. And the people who are fortunate enough to have assets like stocks and bonds and pension assets, those people are able to save and keep that consumption going. But the question is, for how long?
Yeah, and I mean, that's an interesting point, because obviously a lot of the news coverage as of late has focused on the tariffs. But you make the point that what we're seeing on the consumption side of the economy is actually worth watching as well. Give me a sense of how concerned you are. And we hear these warnings from top American CEOs all the time. How concerned are you about what you see in the data in terms of consumer spending? And just to be clear, consumer spending is a huge component of GDP, more than 2/3. And so what happens there really matters.
Absolutely. In the United States, for the longest time now, consumers have been driving where the economy is going. But just to give you a sense of perspective, imports, that the things that people worry about so much, the tariffs on imports are only about 14% of the U.S. economy. So in terms of share, it's not a very large share of the economy. And recently, of course, the obsession is about auto tariffs. Auto spending, even though it's a very big ticket item for a lot of families, auto spending is only 3% of total consumption. We spend 30% on housing, 13% on food, and 17% on healthcare.
Yeah, let me ask you something, though, because
Sure.
Well, I wanted to circle back to something, and we're running out of time here, but you made this point in a recent note that I thought was really interesting. And you say that, at least when it comes to the markets, the volatility that we've seen there is being unfairly attributed to President Trump's tariffs. What do you mean by that? Say more about that.
Well, because the imports are such a small share of the U.S. economy, it's really a small handle to worry about the coming recession. I think what people are really worried about in markets that really is unsaid is whether or not that people are losing confidence about whether President Trump is going to meet his goals of reducing the size of government, reducing taxes, reducing regulation, and making this a good business environment where foreign investors want to invest in the United States. Those are the issues that have been driving the U.S. economy for the longest time now, because on the election of President Trump, all of these points were the hope of driving the MAGA agenda, Make America Great, by improving the employment prospects and investment prospects in the United States. But if there's some uncertainty now as to whether or not he's able to pull that off because of bureaucratic inertia and stuff, then that's why the stock market, I think, is pulling back, because future profits are being delayed even more if he can't meet these goals, especially before midterm elections.
Yeah, and if there's anything that investors don't like, and I would even say most Americans don't like when you're thinking about your wallet, when you're thinking about your job prospects, is uncertainty. Bill, you know, because you have worked at the Fed before, how closely they're tracking all of these data points, and then some that we don't have access to, of course, in the public. 2 rates still the expectations for this year. But Bill, let's say you're at the grocery store, a friend sees you, a viewer sees you, and they say, what do I make of these headlines? Is the U.S. economy going to hold up this year? What do you say?
My advice to everyone has been just chill out for a bit. The news cycle has been hyping up the tariff inflation talk for quite a while now. And I think the real uncertainty is whether Trump will meet his MAGA agenda and make the deregulatory and tax cuts real again. If he does, then we're cool, we're smooth sailing. But if there's any kind of interruption or delay in achieving the MAGA agenda and in delaying these tax cuts and deregulation, getting rid of regulation, and the midterm elections show up and Congress loses attention, that's when Trump loses inertia, and that's where people are going to start worrying. And that's what I would start panicking about the stock market. Not now; it's premature.
So just chill out is the advice. Easier said than done, as are most things. But Bill Lee, we appreciate you being here with us. Thank you.
Thanks for having me.